So Khokon says, this was from 4:30. Khokon says, Michael, why does the time decay not kick in? Can you discuss the time decay on long calls? In particular, my covered call on Apple, August 21st, the expiration 470. It did nothing but go up the last day. Does Power Options tools help with this? Thanks. Yes. Okay, so we talked about this a couple weeks ago too, that the decay that you'd expect is not linear. What I mean by that, Khokon, is that if I sold an at-the-money option for $1 premium for next week's expiration, and I have 5 days, I sell it on Monday morning, Khokon. I sell 5 days to expiration, I get $1 premium. Well, you'd think, oh, you're going to lose 20 cents a day. No, it doesn't work like that. It works the same way as it would for a standard option, meaning your time decay curve. The last 2 days is when you get the most rapid decline. The 3 days leading up to it, you might not see as rapid, but you should see some time decay. Now, keep in mind what's happened the last day and a half, too, depending on your stock. You said Apple, of course. It went down again today, but the VIX was up yesterday. So volatility was increasing yesterday, and then it came back down again. It's still hovering around 22.5. Okay, so you'd want to check your stock to see if what happened to the IV on AAPL. That might have been why you didn't see a lot of time decay if the implied volatility was shifting. So the 470 call, I've got it about expiration today. It's at 497. Yeah, so that's about right. 26.20, 28.45, midpoint somewhere around 27.30. It's pretty close. But let's go back a day. It's also up 25% today. All right, so the 470, okay, yesterday, stock was at 473.10. You're still at 480. Well, that's a 1% time premium for a day. That's not out of bounds because, see, even the 475 is out of the money is at $2. Everything's in perspective. This is a high-price stock. On a $40 stock, I'd expect, okay, let me say a $47 stock, Khokon. It wouldn't surprise me with 1 day to go to expiration that the 47 strike was at 40 cents. The at-the-money strike highest premium at that time, the highest time value premium at that time as well. But you asked me another question, is there a tool that can help you with this? Absolutely. Based on pricing models, based on what you'd expect to see anytime you're researching an option, I'll go out 2 weeks. I'm going to go to the calculators and then to Black-Scholes. Okay, this is showing you the expected time decay. This is an ugly view because it's so short term. I apologize for that. But let me go back one. But when you go to the Black-Scholes calculator, it's showing you the expected decay of the call and the put in this case. Okay, both the call and the put. Now, this is for a weekly, so it's not as good. Let's go to September, October. September will be more than fine. Let's take the at-the-money strike. Go to calculators. Go to Black-Scholes Khokon. That's better. See how quickly it drops off. You're losing about 12 points expected in the last 4 to 5 days. From 9/13 to 9/17, where you lost 12 points in the previous 20 days before that. Just like when you consider the radioactive decay of a 30-day out or 40-day out option, it's similar percentage-wise when you're looking at a weekly or shorter term. You're going to lose the most on the last 2 days, okay? Okay, so that's what we're looking for there. All right. So yeah, that 1% remaining, $4.70 did seem a little bit high for Apple at the close. I'm sorry, yesterday, 1%. That's close. Maybe I'd expect a 0.5% of time premium. But today when the stock rocketed up, of course, that's why you still had a lot of value, and the implied volatility likely increased as well. Potentially that was why it was a harder price there. Okay, Nilesh said, thank you for taking my question. Fernando, you're after this. Thank you for taking my question. When I enter a married put or a call structure, I usually go 2 to 3 strikes in the money, at least 150 days out. Yeah, that's our basic radioactive approach. And he said, with the trade simulator tool, of late, I am noticing that the put option value is falling more sharply than expected. This is happening for many stocks I searched. IG, if the stock moves 5 to 7%, 20 to 30 days, I would expect the gain to be 3 or 4%. Okay, this is a situation okay, and you gave me an example of Facebook. January 21, 275 strike, but simulated trade is a gain of just 1.5, even when the stock is expected to move 5%. Am I doing wrong with regards to the trade structure? No. Okay, so let's do that again. I'll just use the current prices, okay? February. You said 275. I think I might have that wrong, but it's okay. It's quite okay. So in general, when you're looking at a put option, when you go 1 to 2 strikes in the money, in the structure that we want for the radioactive trade, you're basically not considering, but you're going to have a delta of around 0.6. So if the stock moves up 1 point, you're still going to be gaining money. If the stock moves up 10 points, the delta is going to be changing. You should still expect to make 5 points on the position. Nilesh's argument is that recently what he's been noticing is, first off, you want to make sure that you know what your volatilities are. This is a 0.3891 for the February series, where right now the SIV, the average implied volatility of all near-term options on Facebook, is lower than it is further out in time. Okay, so what does that mean? Well, if the volatility stays the same, I should expect that if I see a 10% increase, $26 to put us up at 295, let's call it that, in a month, 20 to 30 days, as you mentioned. Okay, yeah, this looks right to me. $2,800 on the stock, lose $1,400 on the put. That's about right. That's what I'm expecting to see. Now, if I only see a 1% gain on this position, we were at 267. So if it only goes up to 270 in that time period, 299, and now you're saying, well, I shouldn't be losing 404 on the put option. Okay, you're probably right. I mean, the stock is moved up. How are you losing on this? And it's likely because it's reacting more. That's not right. That should have dropped, not gone up. I'm sorry. Hold on. Let me see that. It was at 0.3891, right? Okay. Something is strange here. That should not be. If I lower the volatility, it should not lose more. It should lose less. No. Oh, no, because it's inflated. I'm sorry. It's inflated. Okay. My apologies. Okay. So, yeah, in this case, with a shorter term drop, we are seeing a large amount of time value go down. And my answer to this is I just kind of said it, but it wasn't the right way to set it, Nilesh. I'm sorry. And that was related to, that's related to this option is overvalued. It's inflated. The farther term option in this case is inflated right now because it's been such a long run, such a long extended run, that in this case, the farther out implied volatility is higher than the near term, and that doesn't happen too often. So that's why you're seeing a larger decay than expected with a smaller move on the stock price position because of the inflated sense of this particular option and the options around it. Now, Fernando's question is similar to sort of the topics we've had, and I might jump into it when we were talking about earnings, but it's really not. It's a completely different question. When we started going through the ratio spreads. So yeah, I want to clear this out here. I think Facebook or Apple might be a better example. This might be pretty good too, but let's just do FB. So Fernando's question is, considering the same risk, naked put versus ratio put spread, which is better? Well, the trick is that depends on what is your definition of better. I'm going to give myself 14 days. Good out of the money, not that far, but 250 strike naked put. All right, now, I know you know the what's better, what's not better. Okay, terrible. That's so small premium, isn't it? Well, 0.8% for 14 days. I'd want that for 1 week potentially, but in any case, all right. Max return of $192 monetarily one contract. Monetary requirement of $25,000 for the naked put position and a 0.8% return. Okay, so we're reasonable out of the money. In general, though, you see the best ratio spreads, what you're talking about, the ratio put spread, which is a different animal altogether. I don't know if you're talking about a back spread. Okay, in that case. But if I was doing a ratio spread, what would I be doing? I'd be selling 2 and buying 1. And I think what you want to know is keeping the same strike prices, right? So instead of just selling the 250, what if I sold 2 250s and bought 1? Right? Well, you got a little bit more premium, so you get a little bit higher return. You're looking at $255 instead of $192. You make a 1% return with the same outcomes. What's the same outcome? Stock stays above 250, Fernando, and all puts expire worthless. But you have a margin requirement now of 25,245, a little bit higher. Why is it higher? Because you're essentially in a bull put credit spread at 245 to 250 plus the naked put. Okay, so which one is better? Well, the break evens are about the same. All right, a little bit better on the ratio put spread. Margin requirements a little bit higher because you got to cover the bull put credit spread in addition to the naked put position. 50, 50-50. What's your preference here? I mean, you increase the margin by 245 to make an extra $60 and take your return up to 1%. If the break even's similar, I'd say that maybe the ratio put spread is a better way to go in this case. Won't be the case all the time, but maybe in this case, it might be better, Fernando, because they are similar risk, similar margin. This one's going to be higher, and very similar return. I know I waited to the end on this, Fernando, but the basics here is that they're not really too different of a position if you found the strike price that matches the probability you want on the structure as well. Okay, so they're fairly even. Again, the ratio spread gives you a higher margin requirement because you got to cover the bull put credit spread plus the naked put. You're going to get a higher return because you're getting a little bit more oomph from that higher premium you're selling, but you're buying an extra one as opposed to the naked put. In this case, you get about $60 more, which is a fair percentage, right? It's 30% higher than that $192 maximum return we saw in just the naked put, Fernando. So it's still pretty decent in that case as a gain in return. But against the margin, you just moved from 0.8 to 1%. Okay, so it's not a bad idea. Which is better long term? Hey, I can tell you right now, if your structure is that you're going a certain range out of the money on your planned naked put positions, Fernando, and you've got an 80% success rate on those naked puts, and by that I mean expiring worthless for the max profit. You'd have about the same success rate with doing this ratio put spread. The trick comes that if it falls, you might lose a couple $100 more. If it goes down below both strike prices for a sudden event, you might lose a little bit more on the ratio spread because you're losing on the bull put instead of just the naked put position. Okay, but it gives you a little bit better premium, give and take. All right, and that's essentially it. A little higher margin, a little more for potential risk if it drops down below that strike price of the put that you bought. Same probability as well. Okay. Okay, David, yes, that's discussed in the blueprint. David asked a general question. Is there a general practice for the time remaining to roll to a further output? So in other words, if I'm in that married put, like a couple I'm in right now, following the married put radioactive trading techniques, what's the questionable? Oh, the questionable one is the one that, let me go to, is that in here? There it goes. Questionable one is the one I had to close today on HTS. I got assigned at 37.50. Didn't make sense to roll. The stock gapped up 10%, 11% because they sold part of their company for $40 million and the stock just took off. And I had the September put, okay, which is under 60 days out in time. And that's the general rule, David, is that when you hit this, I started this back in June, maybe a little bit further back, but this was a trade-off. That's a trick. It's a trade-off. I opened this position in June with a January put. I actually moved the put in closer using another income method to get bulletproof before the earnings event that came out. Then the earnings came out and they were pretty good, so I sold the call to take the premium, and then that 10% gap happened. But the general rule is discussed in the blueprint in the exiting an RPM chapter is that when you reach within about 60 days, that's when you want to consider perhaps rolling the put further out in time. Why? Why 60 days? Why not wait longer? Why not milk it for all it's worth and continue to sell premium against it? Because of the discussion that we just had. Let me go to the 210-day out on Hologic. That discussion that we had a little while ago for Khokon. Right? And because in the last 60 days, what do you expect to see? That time value, about $13, or I'm sorry, the time value is going to get decay the most in those last 60 days. Oh, I'm sorry, was this a February or March? It's got to be a March, right? Yeah, March. Okay. So let me clear that up. So here you go, David. What do I not want to have happen? Here I am, 2 months or 60 days to expiration. Yes, I've lost a lot of time value if the stock hasn't moved, but percentage-wise, I'm going to lose this amount, in theory, in the last 60 days. I don't want to lose if I'm planning on rolling out further, David, to increase the position, to continue the position, I should say. I want to roll so I keep most of that time premium. Let's look at this again. Let's clear it out and let me draw it again. I can just use little graphic points to give you an illustration here. All right, so here we are within roughly 60 days to expiration. And I'm going to lose essentially 1, 2, 3, 4 blocks of time premium. I know that's a weird estimation, but let's just take the graph as we have it. That's about 4 blocks of time premium. 1, 2, 3, 4, 5. Oh, I'm sorry. 1, 2, 3. Roughly. Okay, so 1, 2, 3, 4. Yeah, about 5 there, 4 or 5 there, 3 to 4 here. And in the first 60 days, what did we lose? 1, 2, 3. So that's the first 60 days, you only lost 3. The next 60 days, you only lost about 3 again, right? And then in the next 60 days, going here to say here, you're losing 1, 2, 3, 4. In the last 60 days, 1, 2, 3, 4, and it accelerates rapidly. I don't want to wait to here to sell because now there's no time value left. I've wasted the time value, the game of the time value. What do we say in radioactive trading? What is one of the first tenets in the blueprint? Don't time trades. Trade time. And when you see that decay, the standard decay of the option as it goes down here, this is, the last 60. I have a better graphic of this, but it's not up here right now. Those last 60 days, I don't want to let the time value go to 0. I'm closing it out here to keep some of the time value and then extend it out another 120 or another 150 days. That's what I'm going to look for, David. Okay? And that's in the blueprint in the exiting the RPM chapter and the discussion of course, what time frame to originally use is in the first couple chapters of the RPM setup as well. All right. So, ladies and gentlemen, we are at 6:01 p.m. Eastern Time. I don't see any other questions that come in. Sam did have a comment related to, I apologize, related to Lawrence's comment. Sam just offered a warning that, it's dangerous. You should, while you're doing spreads on a volatile stock like NVAX, that's not a great idea in these volatile positions. What Sam is reinforcing is there's 2 important points we always reinforce here. Number 1, yeah, it looks great to see a high implied volatile stock with the premium on a bull put bear call credit spread, but long term, it's not worth it. They swing too wildly against you. Also, the most important thing, of course, is what? Proper position sizing. The position in a bull put credit spread, whether it's on something volatile like Novavax or something calm and stable like IBM, that bull put credit spread should not represent more than 4 or 5% of your total portfolio value. Okay? And any structures along those lines shouldn't represent more than that either. That 15% we talk about. Any spread where you can lose 100% or just buying a call or put, those strategies, leverage that can lose 100% of what you invested should not represent as a total. That strategy should not represent as a total more than 10 to 15% of your total portfolio. Okay, great. David, thanks. Thank you. Always great to have you here, David. Always appreciate your questions. So thanks, David. Stay safe, amigo, says Chuck. You too, Chuck. Take care down there. down under there, and we'll see you very, very soon. Vin, have a great weekend. Thank you, Vin. You have a great weekend as well. I just want to remind everyone else that, of course, today's material and my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk, may not be suitable for all investors. If you liked what you saw today on some of the search tools that we shared for the bull put credit spreads, kind of neat tools there for the market sentiment, as well as analyzing the decay that we showed for Khokon on the Black-Scholes calculator tool and graph, in addition to that handy insurance tool for the married put position to lock in unrealized gains on your stock heading into an earnings. Remember, you can test out Power Options at any time. Just go to powerop.com, put in your name and email address. You'll have full access to the site for 14 days. After that, subscription started only $45 a month for the end-of-day data. Most popular service is the delayed service at $65 per month. We also do offer real-time and increases to interact with the back-testing tools. We saw a little bit of the history of today, but not much. Now, as mentioned, you can check out our webinars at any time. Simply go to powerop.com/webinars.asp or check us out on YouTube. Those videos that we talked about today, or this video that we have here, I'm going to crop this up into a few sections, move some of the discussions forward to work with the other discussions and move some of the other discussions back, maybe a whole section on bull puts, the 3 different questions we had on bull puts in one lump sum. But they'll be available both on YouTube and on Power Options. You can always check out our blog at blog.powerop.com. There is a webinar next week. Ignore that. I forgot that I had to change this too. So webinar next week, there'll be maybe 2 or 3. There'll probably be one Wednesday afternoon. I'll let everyone know when that is, but the open discussion will happen as always Friday at 4:30 p.m. Eastern time. Yes, it will. Remember, but if you do have any other questions before the archives come out that you didn't get to ask today, send us an email at any time, support@powerop.com, and you can also send it to support@radioactivetrading.com. You remember, you can call us during market hours at 302-992-7971, or trial members and subscribers can always schedule that coaching session as well. Okay, so Kip, thank you for joining us today. Thank you for your questions and comments. William, thank you. As always, you have a fantastic weekend. All right, Sam, thank you. Sam says many wonderful points in today's lecture. Look forward to a good weekend. Good luck, and everyone stay safe as well. Okay, and Rex, thank you, Rex, as well. Thank you for your questions and comments. You take care also. Thank you once again, ladies and gentlemen. I'll let everyone know as soon as the webinars are posted. Have a great weekend. As Sam always says, stay safe and stay healthy. And we will see you all very, very soon. Good night.